actually. All right, so we're going to be going over a trade plan. That could be a fairly detailed one if you want to. I've seen people write 7 to 10 page plans out of pretty much every situation that might happen and what to do about it. But then I've also seen very clean ones that's 1 page. You leave it right next to your desktop screen, and it just gives you those quick reminders of what you want. Obviously, use whatever you feel is best. I think shorter and right to the point is usually a good idea because if you get boggled down too much with the all the minutiae of every possible thing that could happen with your Greeks and your Vegas and rows and looking how far out of the money and all that, sometimes it just gets a little bit too much there. So I'm going to share my screen real quick, and then I'll also leave on the chat the. Let me see. I put a sample trading plan document, and you could easily edit this one on your own just to file, make a copy.
Okay.
Just left it on the chat. You guys want to open that up if you have a laptop on you. If you're on phone, you can just follow along on my shared screen.
All right.
All right. So let me make it bigger so you guys can see it a little bit better. If you notice when you've been reading through a few of the ebook strategy guides that I do, they're in a way my detailed trading log and trading plan of how I like to do positions. So it's definitely much more wordy because I want you guys to understand the reasoning why I'm picking the certain, deltas and base expiration and when to buy to close and all that. Um, but to make it a much more succinct version could be helpful for you. And this is one that's not necessarily set in stone, especially if you're relatively new to doing options. You will probably notice certain types of trades are a little more risky for your own risk tolerance than others. So definitely to keep that and just keep aware of that you don't have to do every alert that we give, right? You could do quite a few of the zero DTEs if you want to try to grow an account very quickly. However, you could easily get stopped out and lose quite a few percent right away on those. If you're willing to take a little bit more time, you could do these longer dated 30, 45 days out and still get 2 to 5% returns in most months, which I think it personally is fine with me, and I'm more than adequate to get 2 to 5% a month. Obviously, zero DTE, you can get a lot higher than that, but you also can lose more. So as you're doing these trades, consider also the percent allocations, like how much of each particular strategy are you going to be wanting to actually trade? They're going to write out the plan, stick to it. If you ever deviate from the plan, let's say that you are going to automatically stop out if it hits, say, 0.3 delta, and then it just touched the 0.3 delta, and you're waiting it out a little bit more. That's something to consider and reflect upon. It's not necessarily bad to do that. In order to be pretty consistent with your trading, I would probably stick to the rules as close as possible, even though you might be stopping out in some of them earlier than you really needed to. But the problem is hindsight is 2020 in a lot of cases. So you might do a trade that's starting to go against you and you stop out for a small loss. And then of course it turns and it would have been 100% profit. And then you shoot yourself in the foot and get mad about it, right? There's no reason to get mad about those things. If you were following it through on your trading log and trading plan and you didn't deviate from it, you shouldn't get mad about it. Okay. But here's again, pretty wide open. Feel free to add, edit, but whatever else you want. And I'm here for brainstorming if you have any general questions on what you might want to consider in these things. So first for cash secured puts, just a general strategy, sell a cash secured put for premium until you're assigned the stock, and then sell covered calls. That's what I personally like to do in most cases. I want to pick stocks that I think are in a good strike price. They're not necessarily the best stocks in the world at times, but I think it's a fair strike price where I can be taking in premium on both the calls and the puts. Now you could put your strategy different here. If your strategy is simply sell cash secured puts as long as possible until I get assigned, that might be more beneficial for you because some people like to roll down, they roll out. That's where you go to a lower strike price and you go a month or two out. And you just keep doing that over and over because you don't want to get assigned a stock. So that could be part of your strategy that you might write. Okay. Execution. How am I looking for the positions that I'm going to be doing cash trade puts? I left it pretty broad here. Technical analysis. If you use a certain type of indicator, a certain type of strategy that you look for, feel free to add it there. I like to identify an area of support that's not likely it's going to go below. In general, I usually pick strikes that are below the 3-month low. So if a stock's at say 10 and the 3-month low is at 8, I'm probably going to sell a cash put at say 7. So I'm below even the low of the last few months. And that's a pretty straightforward way to go. Here you can add in whatever indicators, what other methods you're looking to determine. You might have your own favorite indicators. Thinkorswim has a really good one that's free, and you could easily search for stocks that way. Some people use other paid services in order to look for different positions. Here I would like a certain reasonable time frame and how much premium you're trying to collect, and a certain amount of time that it would take to do that. If you're going to be a little bit more aggressive, you might need to take in, say, 5% on your cash in, say, 14 days or something. Mine is usually around 3 to 4% in premium in about 30 to 45 days. Any questions on the cash secured put trading plan? Go ahead, Aaron.
Can you hear me?
Yeah, we can hear you.
Okay. What if you're so familiar with a stock that you've been following it and you know pretty much like I've been following a particular stock. It's a lithium stock.
Mhm.
And it's the ticker symbol LAC.
Okay.
And it's gone anywhere between 21 and to 28.
Uh-huh. That's fine. In your trading plan, you could say when the stock goes close to 21, say 23, 24, I will sell a put at 21, and I'm relatively certain that it won't go below it based on previous data. Something like that,
Right.
something that you could write down.
Yep. Yeah, I actually did that today, and I collected a lot of premium on it. So and I'm fine with getting assigned it, because I know it's such a volatile stock, because I know later on it's going to be in big demand. But I'm fine with owning it one way or the other. I've just kind of been playing with that particular stock just as it's a really good one for doing that.
Yeah, that's good to have your few ticker symbols that you're so used to seeing the stock price. You're reading the charts on it over and over, and then you can kind of see patterns quite a bit where, yeah, when it hits that 23, it's going to start bouncing up, and almost every time it might bounce up. So that could be a good time to sell a put. And then you can also consider in your trading log, I would sell a little bit closer to in the money if it's at a certain price because I'm willing to take in more premium. Maybe if it was much higher, like 28, you might want to be a little safer on your cash put at that point because you know that it's near its high. So things like that to write down would be really useful, I think.
Okay.
Anyone else have any questions on possible writing out for your cash puts?
Just a quick question. This is
Raj.
Raj. Thank you, Lance, first off, for having this. You're awesome. What are the, and I know we probably won't necessarily talk about this, but as I hear about this term cash secured put, can you just differentiate that from naked put and Reg T margin versus cash, if you will? Like, I'm just wanting to know just a little bit more about your thoughts on some of that part, because as you come up with your setup, does that influence at all any of your trade decision making? So the example would be if I put in a certain trade into like TOS or Tastyworks, for instance, I can see the effect of buying power when I sell that put. Is that something that we're looking at all?
Yeah, I mean, you could easily put that in your trading plan, and there's nothing wrong with that. So we can say Reg T margin. That's for most accounts that are, I think, under 25,000. I have to double check that in my top of my head. You also have portfolio margin.
Yeah, I would say under so Reg T is anything under 125 typically, and you have to go probably past 125, 150 depending on your broker if you
Right.
want to do PM portfolio. But I
Right.
was just kind of curious about if that makes it to the plan.
Yeah, I mean, you could easily put that in your plan if you're willing to be doing certain positions that are cash secured, like the absolute go-tos, where I don't want to get hurt with margin. You know, your absolute favorite stock, I would probably just do cash secured and not really worry about too much about the margin of it. Or you can even go the opposite way and be like, this particular stock, I'd rather not get assigned on it, but I'm going to put it on the margin account and I'm just going to try to roll it over and over. So yeah, it really depends on where the account is. Like if you have a stock at like say $40 a share, if you sell a cash secured put, that would take I'm trying to use this whiteboard. It's super small here. All right. So it'd be 40 times 100. We're looking at $4,000 in a cash secured put, right? That's if you sold a cash secured put at the 40 strike price. Obviously, whatever you're selling at your strike price times it by 100, that's how much cash you need in the cash secured puts. All of the trades that I give in the recommendations, I personally leave as cash secured because I do them in the Roth IRA, and you can't do margin requirements on there anyway. And I think it reaches adequate returns for the strike prices and the deltas and whatnot anyway. For margin of Reg T, I mean, I also think it might depend on the brokerage, but Tasty trades a lot lower. I can't type here. All right. There you go. All right. For Reg T, it might be about 30% or so. I don't use all these other margins, by the way. So you can take your 4,000 and then times it by about 0.3. You would use about $1,200 or so. And Raj, if you did one on portfolio margin, do you know approximately how much it would be on a $40 stock?
It really so
Yeah, it depends on
first off, it depends on the type of stock that you do this on. So the example I'll mention is like Riot, for instance, has 100% occupancy, meaning if I sold a put on Riot, I have to have all of that cash available because that's 100%. But if I sold a put on SPY, I think SPY is like only 20%. So you only need 20% of the full amount to get to maintain that position.
Yeah, yeah, that's a good point. Depends on the ETFs. In general, the ETFs are lower. If it's a blue chip stock like Apple, it'll be lower. If it's a meme stock where it can move a lot, they usually want the whole 100. And then the span margin, this is for futures. So for futures trades, it's going to vary anywhere between, depending on the VIX. Oh my goodness, where'd it go? Okay. I'm not using this whiteboard. Okay. For span margin, if you do one on, say, MES, it's going to need about 400 to 500 or so in most cases. But I would leave the same amount in cash. Span margin is ones where you got to be very careful. It's like portfolio margin with futures. And that's the only one I'm willing to actually do. I'm not willing to do portfolio margin even if my account was that big. That's just my opinion on it. But yeah, so going back to your question, if you're going to do a trading plan, depending on the type of strategy you're using, you might want to write out different things for it. And we can walk through one-on-one more about what might suit yours in terms of this strategy we do this, but that strategy we do that. It's really up to you. It's not like a one size fit all answer. Does that make sense? All right. Any other questions on Kesker put? You could do specific deltas if you want. You could say I'll always sell a 0.2 delta on, say, Apple stock that I'm used to selling premium on. And then if I'm assigned, I will sell a call at the same strike price of what I got assigned at. And that could be a good trading plan for that. Let's look at the spreads. Credit spreads, you could possibly write a little bit different things. Let's see, where did I put it? Oh, I did two options here. Let me just go over this real quick. For the second option for Kestrel puts, maybe you'll sell at a certain delta or lower as long as you're getting a certain amount of premium. So some people like doing it that way. Let's say your target return is say 2.5% a month. You're going to find the delta that's the lowest that will get that target return. If you're going much higher delta, you could get a higher return, but then you would get assigned more and then you have to manage it more. So usually you want to go for the lowest delta that will reach your goals in most cases. And then management, I'll always get assigned, I'll sometimes get assigned, or I'll never get assigned. Some people never like to get the shares. If you're in margin, it is beneficial to stay on the sold put side and then getting assigned the shares for your margin requirements. So that's why a lot of people like to roll it down and out as much as possible before they start paying margin interest. So that's definitely something I would consider if in the management for that. All right, let's look at credit spreads. Credit spreads, you probably want to write something a little different because we're not only selling, we're also buying a contract, right? So we can sell a credit spread for premium until it reaches a target profit or close the trade at a loss. And you could have a very specific target price where if it goes against you, you're not going to lose the full width of the spread, but you're just going to stop out. And then you can, again, add your indicators, add your reasonings behind why you're picking those certain positions. It could be, again, I need to take in, say, 5% premium. So that'd be 0.25 in premium in 5 width spread, because you do 25 divided by 5, you get 5%. And then it might be in a certain amount of days, like 45 days or something. Maybe you do a automatic buy to close at say $5, or maybe you just let them expire worthless, or any other avenue. Some people that are pretty heavy traders, they'll buy to close them early just because it hit a pretty high rate of return in a short period of time. Like if you sold them spread at 0.32 and then you could buy it back for 0.2 in about 2-3 days, it might be worth it because you just made about 2% on your money in a few days. So little things like that might be stuff that you might want to consider writing in there. Stopping out, I would write down when are you going to actually get out of the trade. So let's say you sell let's say a stock's at $100 a share and you sell an 85 put and you buy an 80 put. You would want to have a certain price where you're just going to get out of the trade completely. Because if it goes below that $80 price, you're going to lose all of your money minus the premium you collected. So that could be about $470, $480 in one contract, which is a pretty dramatic move for one contract because we're only taking in about 25, $30. So definitely want to put some sort of stop out. It could be a certain percentage above where your sold put is. It could be a certain delta that it reaches. Like I usually start mine around 0.08 to 0.12 delta. If you see the short hit 0.3 delta, then you might want to get out of it, for instance. Coming up with some sort of support resistance lines. If you see how we're selling at 85, but it touched around 88, 89 a few times. If it touches there again, maybe you just stop out. Real quick, I wanted to show you a few ways that you could actually put these alerts in. So, for instance, let's say I was selling a quick credit spread on Microsoft. Delta, let's say 0.09 or so. I'm going to sell the 210. You want to click on the bid price and go to 205, hold the control button and click the ask price. And that gets you with your credit as a vertical credit spread. Quickest way I found to do it. You can also right click over here and do vertical and whatnot too. What you could do, let's say I got filled on this for 0.3 or so. If you right click on the delta, so that 210 delta is a 0.09, you can set an alert on your deltas. So right now at about 0.09, maybe I'll do it negative. You have to keep them negative because they're puts, negative 0.3 or so. And then if it goes to 0.31, 0.32, it's starting to go against us, and you probably want to get out of the trade. It's up to you if you want to pick 0.3. That's probably a reasonable 3x stop in a lot of cases. It depends on when it happens, obviously, and all the other variables in play. All right, any questions on credit spreads for writing a trading plan? Yep, Josh made a good point there. If you do have enough funds for it, so let's say you sold a put and bought a put, you could sell the bought leg for profit, knowing that if you're still happy with the strike price of the sold put, like for Microsoft, if I was at 210 instead of 240, I'd be pretty happy buying it at 210 if I could afford 100 shares of it at 210. That's a good discount, right? It's almost a 20% discount from what the current price is. So yeah, if you're able to do that, that's another thing that you can write down in your strategy too. You can have specific plans written out for stocks you wouldn't do that with, and then plans for stocks that you would do it with. So it's up to you. You can get really deep into this stuff or just keep it very small and succinct. All right, what questions do you guys have? Technical indicators do I use? Can you hear me better now? I'll stay close to the mic. Sometimes when I walk a little further away, it's a little harder to hear it. All right. Main technical indicators. I don't go super crazy on this stuff. I mean, there's a lot of them out there, but too many indicators spoil the broth, I feel. So for Microsoft, and my default is the RSI on the bottom. So right now we're in the daily RSI. If the RSI is above 70, we overbought, and then it probably will start pushing downward. If it's at 30 and it's oversold, then it might go up. That's a very common one that I'll look at. When it's in the middle, I don't mind selling a quick credit spread for it on a blue chip type stock here, because for it to go from 240 down to 210, theoretically it could. It got close to it, but probably not going to happen. I've used Bollinger Bands and Keltner channels, where if you want to see if there's a big divergence between the two, I think Keltner is the purple, I think. I don't even remember. It's been a while since I used them. As you can see here, pretty far away. It's about 1 standard deviation away. And the stock's on the lower end of the band. So what a lot of people think is on these is they go to mean reversion, so it might bounce back up. So there's a good chance Microsoft will possibly bounce towards the middle of these bands in the next few weeks or so. But when the bands are very stretched out near earnings season, then they could start to move dramatically. And then when it's not earnings season, they kind of stay pretty level and face there. I've used MACD before. I've done moving averages occasionally, but I don't really use too many besides those. Other questions? This is your time at this point, guys. Pretty much had everything that I had prepared. So if you have any general questions on any of the strategies, I know a few of you guys are new here. Are you guys able to find everything okay? Like where the alerts are and how to enter them in right, all that stuff?
I had a question.
Okay.
Can you hear me?
Yep.
Okay. How do you find delta? Is there a formula, or what is delta?
Do you use Thinkorswim or do you use a different brokerage?
Not yet. I have E-Trade. I haven't used anything else.
E-Trade it'll show you the delta there too.
Well,
yeah, it's up there. E-Trade is perfectly fine. You can stay with them if you wanted to. The delta, the technical definition of delta is if the stock goes up $1 based on your delta, the premium should go up that same amount. So right now, Microsoft's at 240.45, and if I'm at 240 for the call, it's a 0.54 delta, meaning if Microsoft goes up $1 to 241.45, this premium will go up from around 850 plus $54. So it'd be about 9.04 or so. So that's the technical definition of delta. Does that make sense?
Yeah, yeah,
Now, if it goes backwards too, like if it goes down $1, you lose that much in your premium. The reason why we use delta is it's a very good close approximation to what odds are that it'll get to that certain strike price when the option expires. So right now, at the say 230 strike price, at 32 days from now, it's a 0.29 delta. So about a 30% chance Microsoft's going to go down below 230 at that expiration date, 32 days from now. Okay.
okay,
Now, if I go only say 5 days away, or 4 days away, the 230, there's not much time for it to get there, right? Because we only have 4 days left. So the delta on that one's 0.1. There's a much lower probability that it would get to that 230 in 4 days compared to say a month, right?
Yep.
So with the same exact strike price, the further out in time you go on them, the higher the delta, assuming the exact same strike.
okay,
Because you have more time to get there.
right, got it.
Any other questions? Anybody? What's the advantage of 3 month SPY versus 45 DTE? Okay. 3 month SPY, you could go really far away in your strike prices because we're going 90 days out instead of 45 days out. So the advantage is you can stay further out of the money and still make a pretty decent target return. However, it doesn't decay as fast as the 45-day ones because as you get closer to expiration, then they're going to decay more because it has less time to get to that price. In general, if the VIX is pretty high, I like the longer dated ones because you could possibly get out of the trade just when the VIX drops, and even if the stock didn't do anything. Yeah, you can play with the different DTEs. Some people love doing 0 DTE or 1 DTE. Quite a few people play weeklies. You can do Tesla weekly or Apple weeklies. Some people like doing monthlies. They all have different risk return profiles to these. The main reason why I pick the between say around 22 to 45ish days is that's where you get a good amount of theta decay on the out of the money call expirations. We got about 6 minutes left. Anyone else have any questions?
Lance, do you ever trade weekly expirations or just monthlies?
I used to do some weeklies. I don't really much anymore because I don't see much of a benefit to it. If you're gonna be selling 4 different weeklies instead of one of the monthlies, you might eke out a little bit extra in return, but then you're paying 4 times as much in commissions, and then you're also having to possibly manage it a little bit more. So to spend a little bit more time to do all that, it's up to you if you think it may or may not be worth it. To me, I didn't really see much of a benefit to it. But
Well, actually, the reason I'm asking is if I wanted to make the 3 month SPY trade one of my core trades and do it on a weekly basis, like every Monday, I put on a new 3 month SPY and build a ladder.
yeah.
You'd have to use weekly expirations to achieve that. There wouldn't be a problem with that, would it?
I don't think.
Yeah.
Let me double check. The reason why I started it today is it's the Monday after OPEX. So it's very clean to go to the next OPEX 3 months from now. I'll do SPY or SPX, won't matter much. You could probably get very close within a few days. Obviously, if it's a holiday or something, it's not going to necessarily match up.
Yeah.
So right now you can do 88 days. If you wait till next week to add another one in, you'd have to do the 102 minus about 6 days. So you're at 97 days. And then the next one a week after. So it won't line up perfectly. But since it's so far out anyway, like you probably won't really notice much of a difference. So you could easily do it that way if you wanted to. Yeah, I like laddering it like that too, because if you see a dramatic move 1 week, your next strikes will be much safer in whatever side is getting challenged. Assuming you stay in the same deltas. So my play is best sold on a Wednesday. Any reason why, Roz? You remember? I'm not sure.
Yeah, that is based on another podcast that I listened to, where the guy did back testing, and turns out Wednesday is the day that if you're selling options, I think the way that the guy did the back testing, he looked at Monday, Wednesday, and Friday,
Yeah.
and turns out that the win rate is the highest on Wednesdays. And he was actually looking at 7 day till expiration, not 3 months. So
Yeah.
I don't know about the 3 month part, but he was using back testing software for this.
Okay. I heard I forgot the name of the guy, but there was one person that was doing he looked at the expected move of SPX for the week on Monday, and then if it hit like one of the 4 quadrants away from it, to essentially break up the expected move into 4 quadrants. If it goes up one of the quadrants, then you essentially trade the other direction only, because there's a very low chance it's going to bounce down like 3 quadrants the other way. I don't know. I've never actually traded it before, so I can't really give much advice on it. But I did see it. It was interesting. It's like you're essentially saying that the mean reversion won't be dramatic. Any last questions? We got about 2 minutes left. All right, I guess we'll just end it there, guys. Definitely appreciate everyone from being members, and appreciate you guys signing on today. Feel free to send me a message at any time on Discord, and we'll see you guys around. Have a good night,
All right,
guys.
thank you.
Thanks. Good
Thanks,
night.
Lance.
All right, thanks, guys.
Have a good night, guys.
Good night.
Thanks, Lance.
Bye, everybody.